Good morning, ladies and gentlemen. My name is Caroline Mavuti. We shall now begin the investor briefing. I would like to welcome you to Nairobi for those who are not from Nairobi, and to Kenol Kobel. In a few minutes, we'll just give you a security briefing, but before we do that, the agenda can begin. And I will now hand over to Pat Lai, our Group Finance Director, to introduce the panel and kick off the agenda. Thank you.
Welcome, everybody. We're really pleased that you could attend this session, that we could engage with you more and give you a briefing of our past year's performance. Before we go into the presentation, I just want to introduce Mr. Mathenge, who's our chairman, and everybody knows our group MD, David Ohana. The directors that were unable to attend today, Terry Davidson, he's traveling. Mr. Ndonyi had a urgent last-minute engagement, and Mr. Oyatsi has made his apology, so they will not be attending this morning. I'll hand over to Mr. Mathenge just to make a few remarks.
Good morning. On behalf of the board, I want to welcome you all to this what I would call our 2015 Investor Conference. We are pleased by the turnout because you've had to spare your time and the challenges in the market. So welcome, karibu sana. And without further ado, I think what I would like to do is to make a few remarks before we get into the actual presentation. I'm pleased that we are here. We've come this far. You know, most of you will recall that in 2012, we made a significant loss. I think it was 6.1 or 6.2 billion, I believe it was. And I'm pleased to be able to report that I think we finally come out of the woods. In 2013, if you recall, we made a modest profit. After tax, I think it was 513 million Kenya shillings. 2014 was actually a great year for Kenol Kobel. We made just about 1.1 billion Kenya shillings after tax. And that is a significant turnaround. They're coming, if you imagine the move from 6.2 billion negative to a positive 1.1 billion, that's a significant turnaround of the business. It did not happen by accident. I think we embarked on a strategy as a board, and that strategy has paid off. First of all, we focused on corporate restructuring of the business in countries where we do business, and also mainly in Kenya, in Kenol Kobel. We strengthened our governance structure in line with best practices in the market. And that had a huge impact because the board started playing its rightful role of setting strategic direction. And our engagement model with the management was also enhanced. And I think as a result of that, we were able to accomplish a lot in line with international and good corporate governance standards. So that has worked well for us. We also looked at our human resource base. And a lot of people would say, yeah, there was retrenchment. I like to consider it as right sizing. And that has worked. I think it's clear to everybody that, or it was clear to everybody that we had a bloated workforce, and we were able to restructure and reduce the number significantly. And that was done in an environment that allowed us to continue doing business without hurting the productivity of employees who are retained in Kenol Kobel. And that was helped by focusing on a good change management program. And we started looking at our human resource base in terms of the skill levels, in terms of the competences, both leadership and functional competencies that are required by the business. And that's an ongoing activity. I think we're trying to match we've identified skill gaps And we are now focusing on developing our human resource potential to be able to deal with any competency and leadership gaps. And that has helped to quite a large extent in motivating again the workforce and ensuring that they remain committed to delivering on the objectives of the company Ken Okobo. What we also did was to focus on cost reduction. And these are not, these are not earth-shaking or transformational, if you will, initiatives. I think every business has had to deal with this at some point in time. But what is unique is how it was handled in Ken Okobo. We decided, for instance, that we would de-risk the business. In the past, you recall that, and one way of doing it, because we had we had very high operating costs. We also rapidly expanded in markets without necessarily on many occasions thinking through the process and looking at what would be the bottom line impact. And that rapid expansion also came with a lot of other challenges. And one of them was, we were also very strong in OTS, in the trading activity. And we opened trading offices in Tanzania, I think in Mozambique, in some other places. We had depots, it's still there, I think, in the Congo. And we basically built or expanded and generated what I would call idle and underperforming assets. And in 2013, we had to deal with that. I think if you look at where the profitability came from in 2013, quite a bit of it came from disposal of idle and underperforming assets. That's not the case. I think as we moved into 2014, we had done a lot of that. And if you look at, and I'm sure you guys have done your analysis, if you look at the profitability in 2014, most of it has come from operations. And one of the things we did to be able to improve on profitability was reduce the debt levels. That has worked extremely well. And also reduce the financing costs. And that is something that we continue to focus on. I think it is true to say that at some stage we were truly working for the banks because we had to finance not only our expansion activities, but also our activities in OTS. So what we decided to do overall was forget participating in businesses that do not have a bottom line impact. And if you recall in 2012, when we made that huge loss, our turnover was in excess of 200 billion Kenya shillings. And that is the highest I'd ever seen. And I've been in this industry for many years. That is the highest I ever saw from an oil company. In 2014, you'll note that our turnover actually came down to just below 100 million Kenya shillings. Then you need to contrast that and compare with the bottom line profitability of 1.1 billion. So risk management is something I think that we've done well. The major risks that continue to face the business include cash flow. They include volatility in the market. It is true that, yes, oil prices have come down, but we're seeing quite a bit of volatility, and that can pose challenges in the marketplace. We also see financing costs in Kenya are still relatively high. And I'm sure, David, you comment on that at some stage. I think it's something that we need to continue looking at very, very closely. The other major risk for this type of business is obviously foreign exchange. The Kenyan currency is depreciating rapidly, and we're hoping that something will have to give in that respect. And in fact, what is helping is that we've been able to manage our inventory levels very well, and that is something that you can quickly see in our financial statements. But those who continue to be challenges, I think our commitment is to remain focused on the fundamentals of the business and also remain focused on a flawless execution, and at this juncture I must thank management because I think we agreed a strategy. Management agreed a strategy with the board, and execution of that strategy has been almost flawless. So management, thank you very much. We also must thank our partners in the business. You've been very supportive. I think we saw a bit of ups and downs in the relationships, particularly after that 2012. But I think it is true to say that the engagement levels with our partners have also been enhanced. And it is our commitment to continue doing business with our strategic partners to ensure that we continue to grow the Kenokobia business. Ladies and gentlemen, thank you very much.
Thank you, Mr. Mathenge. I think what I'll do now, I'll go straight into the presentation, and then we can then hand over to David. He'll also be commenting as I'm doing the presentation, and then we'll have a question and answer open session. The presentation that I'm going to do actually includes a bit of history as well, because I know we have got new faces here, and welcome to you as well as people that we've been dealing with for many, many years. So there's a bit of history so that everybody just gets a good background. So Kenol Kobel was started as Kenya Oil Company many years ago in 1959, and the shares were listed on the Nairobi Securities Exchange shortly after that. And for years we operated jointly with a company called Kobel Petroleum. That was another company that bought over Mobil when they exited from Kenya, also in the 1980s or 60s or thereabouts. And Kenol and Kobel operated under a joint agreement. So eventually, because for years people thought they were the same company, eventually in 2007 there was a share exchange where the Kobel shareholders took shares in Kenol, and the Kenol and Kenol of course acquired Kobel as a full-fledged subsidiary. Then in 2009 we then changed the name of Kenya Oil Company to Kenol Kobel to incorporate the two companies. Our main business across the region is marketing of petroleum products in the downstream. So our vision is to be the leading brand in the markets where we operate in, and our mission is to develop and improve our quality and total value of our products and services. And we also strive to become a market leader through continuous innovation and with our quality products and services. We also maintain highly motivated and well-trained human resource, and our chairman mentioned this, and David will also go more into it. It's one of the key focus areas that we focused on during the time when we were in our recovery phase that actually contributed a lot to our recovery out of the problems that we had. And then of course the ultimate aim is to deliver higher shareholders value. So on our board, we've got 4 non-executive directors. You've met Mr. James Mathenge this morning. Mr. Oyatsi, he's not here. Terry Davidson, the KCB people will know him well. He was from KCB and a lot of banking experience. And Mr. Daniel Ndonyi, he's also not here today. He used to be the partner in charge of Deloitte, retired now. Then the 2 executive directors are David Ohana and as the group managing director, and myself. We also have board committees, the board audit and risk committee, where our board sits, as well as our internal audit manager, and we also invite PwC to sit on that committee. So it's a full functional committee that looks at all the governances and the accounting and finance side of the business and the risk issues. Then we also have the nominations and HR and remuneration committee, and that's chaired by Terry Davidson. Sorry, the audit committee is chaired by Daniel Ndonyi. Then internally, our structures are made up of a group management structure, where this is the the committee that actually drives policies in the group and makes the decisions that needs to be done strategically. And it's made up of a country manager from each subsidiary. And of course, our group managing director is on the committee as well, chairing it. And then we have the group M&A and regional support manager, Patrick Kondo, for those who know him. He's not here today. He's actually at one of our subsidiaries just concluding some transactions. Then we also have our specialty products manager, Mary Mwangi. She's in charge of all the specialty products, non-fuel, LPG, lubricants, bitumen. So that's our group management team. And then each subsidiary has a local management team, and that I won't go into. Typically, it's like a little board that takes care of their operations with a very strong reporting line to head office, because the ultimate decisions and the controls are actually made in head office. It's one of the things that actually helped us a lot in the past 2 years to come out of the problems that we had, because we also saw that the subsidiaries were very weakly constituted and the policies were not being followed. And so we had implemented lots of control from Kenya, as well as looking at their financial books. We have constituted a panel of accountants that actually look at all the books of the subsidiaries with dedicated accountants for the subsidiaries, and that has helped us a lot to keep the books clean and make sure that they report the correct figures monthly and do the recons. So our group is made up of, as I said, subsidiaries and Kenol Kobel. Kenol Kobel is the holding company, and the subsidiaries are Kobel Petroleum, and all these are 100% held by Kenol Kobel. Then we've got Kobel Uganda, Kobel Tanzania, Kobel Zambia, Kobel Rwanda, Kobel Ethiopia, Kobel Burundi, and then Kenol Kobel Congo. That one's only got a depot, so it's not actually a fully fledged subsidiary operational. As far as our network is concerned, we have in Kenya 156 service stations. In Uganda, we've got 48. In Tanzania, we've got 20. In Zambia, 26. In Rwanda, 58. And heading to 60 actually, because I'll go more into that in a minute. And Ethiopia, we've got 75. And Burundi, we've got 38. We always look out for opportunities for expansion in these subsidiaries. And I must say that the subsidiaries where there is still a lot of potential and a lot of development opportunities is Rwanda, Burundi, and also Zambia. So those numbers aren't, they're growing as and when David's identifying stations with the country managers to actually do takeovers and do the organic growth. So our market segments is the retail sector, which is our network. We actually have also K-Gas, which is our LPG. We've got exports, supply and trading, where we're not so active anymore, because that was one of the business segments that was exposing us to high risk and very low margins, so also contributed to losses in the past. And we've got our non-fuel business, as I mentioned, lubricants, bitumen. We're also in the reseller market, and then aviation, commercial, and fuel oil. So if we can go now onto the financial summaries. This is our P&L. So I will just highlight the major items to take note of. I know a lot of questions are always asked about the volume drop from year to year. And as our chairman mentioned, and I'm sure the people who have watched David's interviews on TV, it was all about managing the risk in the company and going for profitable business. So the volume is not as significant as pursuing business that is profitable. So if you look on the comparison between 2014 and 2013, you will see that although the volumes have dropped and sales to an extent as well, the significant to note is that the gross profit has actually increased. So we went from 4.2 billion in 2013 to 5 billion in 2014. And the GP percentage actually improved a lot. So we went from 3.9% to 5.5%, which is actually a very good GP percentage, especially in our industry and our downstream market. Then we had other income where our chairman mentioned that in 2013 we had disposed a lot of non-performing assets, so that 1.4 billion had quite a significant amount of gains from sale of assets. But in 2014, there's very little there. We sold 2 plots and the gain was not so much. That's genuinely other income, which is from our non-fuel business, from our hospitality business for storing product for others. So that one is part of the foundation of the margins, you can call it that. Of significant as well is our admin and operating costs. You see, if you can just look at that line, I don't have a pointer, but if you look at the admin and operating costs in 2012, we incurred 5.2 billion and we dropped in 2013. So you can see here the 5.2 billion that was incurred in 2012, and we then did have a big cost reduction drive and business re-engineering as we were going into 2013, and we managed to actually reduce the cost to 2.5 billion. That reduction from 2013, from 2012 leading into 2013 was 52% reduction. And then in 2014, we closed with operating costs of 1.8 billion, and that in itself was a further 25% reduction. And despite a lot of people thinking it was retrenchments, still, you will see from another slide that I'm going to present that it was truly cost savings and not from retrenchments. It was really focusing on costs that were, I think in the past, probably not focused so much on it, like consultancy fees, legal fees, things like that, that actually managed to reduce the fee to a level that was a bit better than let me say, our competitors. So that's also listed on the exchange, securities exchange. Then we had the exchange losses. I'll also talk a little bit about that. We're not happy about the 367 that was incurred, but you will see when I get to the graph what caused it, and we will talk a little bit about what we're doing to mitigate that we don't land up there again. Of course, it's an area of risk because, as you all know, the shilling in Kenya actually in the last few days actually really depreciated quite hugely, quite to scary levels. 96.80 yesterday, so today was a little bit better. So on our EBITDA level, you can see in 2012 we incurred that massive loss, mainly as a result of the exchange loss of 4.6 billion, but also we had some huge expenses, as you know, and then some very poor performance on our gross margin, and that's why we only achieved 1.7%. So you can see in 2013 we achieved 3 billion EBITDA, and we improved that to 3.8 billion in 2014. Our financing cost is an area where we're really focusing on, because as you can see, it's a huge item on our P&L, almost as much as our admin costs in total. So it's an area that we are really giving a lot of attention to, and it's about reducing debt and getting negotiations underway with banks to actually have a look at the rates, because it really is a very worrying area for us. So you can see actually we've made quite significant progress. In 2012 we spent 2.3 billion financing costs, and in 2013 it dropped to 1.6, and that was a 28% improvement. And then in 2014, we managed to achieve 1.2 billion, which was a further 22% reduction. And this still needs to be reduced further by reducing debt and, of course, the basket that we have to reduce the actual financing costs. The depreciation increased slightly because of our new depot in Zambia mainly, and also new stations that we acquired, as I mentioned, in mainly Rwanda, Burundi. So if you look at our profit after tax, it's you can't see it very well here, but we achieved 1.1 billion after tax profit. That was a 95% improvement from the 558 million that we achieved in 2013. And then, of course, the big loss that we had in 2012, which for us was the significant turnaround that helped us get underway from 2013. I know this question a lot of investors and banks ask. The split of the after-tax profit between Kenya and the subsidiaries. So you can see over the years how it went. So the top line is Kenya. You can just read it off the screen yourself. And then the second line is the subsidiaries. And this is the total group. You just saw the 1.1 billion that we achieved in 2014 and the 558 that we achieved in 2013.
This number, we usually in the booklet you can't get this data. It's just for you to get the feel. First, when you see the 136, when you compare it to the past, we are talking about the contributions of subsidiaries to the bottom line. This number is after, Pat mentioned that we created a committee, we call it the cleanup, and we are meeting every month. I'm chairing that meeting. So it was very tough, I can tell you, during 2014. We launched it around March, yeah. Around March 2014, and it was accountants, some of them are here, and allow me just to introduce Chege. She's doing stocks, and they are senior accountants. She's doing stocks, payroll, what else? Stocks, payroll. Stocks, it's some account that we had big mess in the past in, we call it 2915 in Oracle. I can tell you when Puma was here, and Andre can bear me witness, it was one of the accounts that we could not explain to them exactly. To clean up that account took us almost a full year in 2013. Then what we did in 2014, we cleaned the subsidiaries 2915 because subsidiaries are also on Oracle. So it's something to do with stocks, provisions. I can tell you it was hell of a mess. Guni is doing AP, and I'm just giving you an example. It's, great people that in the past, I told them always they were great employees but bad politicians. I'm also a bad politician, but I think I'm better on working. So we just changed we created a committee of senior accountants, and they are in the group reporting straight to Pat. They are not they are helping us on Kenya on some items, but we took such, and they are here. There is Gituku. Where is Gituku? There is Maina, which soon will move to Zambia, but Maina is managing stock for us. So there are key accountants that sat and started cleaning up throughout 2014. I'll tell you, some days we'll see even fireworks in the office, cleaning each subsidiary. And we cleaned $3 million. I'm telling you past issues. And again, when you see the 136, just take 90 shillings to the dollar, or 95 times $3 million. It's actually what the GP that subsidiaries did. So we went on past issues. So what I want to say, some subsidiary came and reported he has 2 million PMS. Fine, go and show us the PMS. We go, we send an accountant from Kenya. He goes, measure the tank, telling him, no, it's 1.8. Investigating, blah, blah, blah. You can't prove that you have the 2 million liters. We write off that. And I'm telling you, all was to do with all transactions, mainly to do with the triangle, which is Burundi, Rwanda, and Tanzania. Remember, Tanzania is the one feeding. We are changing it now. But they were the ones feeding Burundi and Rwanda. We entered to a mess because there is some rules in Tanzania that they are measuring the ship. Then whatever you get in the tank, nobody accounts that number. You pay on what was on board, so you go and bribe the survey if you are the supplier. This is the way they are making money in Tanzania. Then you pay for something that was on board, on the ship, but when you get it into the tank, people are connecting to the pipe, all sort of games. So people in subsidiaries were booking the stock they got it on the ship, but we never got it physically into our depot. So all those losses were to be written off, so it accumulated to $3 million. So subsidiaries generated that cash within 2014. The 136, which on its own, if you check the past, it's not bad, but it was around 400 million in 2014. Contribution of subsidiaries to Kenya, it's 60-40. Remember that number. And even when you go this year, 2015, 4 months, it's around that level. So in 1 month, we can come down to 70-30. 1 month that they are doing extremely well, it can be 50-50. But as a ballpark number, it's 60-40.
Let's run through these graphs quickly. This is just the volume, and the item on this, the year-to-date March, is just for 1 quarter, so you can kind of extrapolate by 4 to get the year. So we will kind of do a little bit higher volumes than we did last year, but I spoke a little bit about why we're not chasing actual volumes. Net sales, the same sort of story as the volumes. Now, this is the one that's actually significant for us because this is the one that generates the money and the profitability. So we have focused now on actually improving the business mix and going for profitable business, and you can see that actually it had paid off. So in 2013, our GP actually was much better than 2012, where we know that there were problems with high stock levels when the prices were crashing. So we suffered some quite significant gross margins there. So, and we even improved it further in 2015 to achieve a gross margin of 5 billion shillings. Now, the year-to-date GP of 1.5 billion, it's actually a very, very good GP for the quarter. We had really an excellent quarter where we were under David's leadership, of course, because he manages the stocks and what our stock requirements are and supply, so that we can maximize our positions and actually benefited from the drop in prices. So that actually helped our gross margin significantly. So if you look at the percentages, it actually explains it better, where to achieve a 9% GP in this industry, in downstream, is actually a excellent margin, but that was because of the inventory management that was done. On our overheads, this slide includes all the overheads, which is the total expenses, including depreciation and amortization. So you can see we spent humongous amount of money in 2012, 5.8 billion, and then the cost savings, the cost cutting drive came in. So we closed 2013 with 3.3 billion, and as I said, in 2014 we reduced that even further to 2.8 billion. And this level of expenses is the one actually tough for us now to cut furthermore. But the culture, as our chairman said, has been a changed culture in the company, where people are very focused on managing the costs and looking at things that they are signing and approving before just signing off things. So the culture is actually much better, and one of scrutiny and investigation before letting any expenses go. And still, it's a big drive still for us to keep our eye on this ball. So this number of employees, what I wanted to show was that if you look at our all-time high, which was like in May 2012, Kenya had 335 employees, which is that green bar. Then we went into quite a lot of restructuring and right-sizing, as Mr. Mathenge said. So we got down to that level, and there were some more retirements and natural attrition type of people that left in 2012 and 2013, sorry, but there was no more retrenchments after the whole 2013 drive. And you can see in Kenya we even increased, because now we are at levels that actually can sustain our business. And if you look, it's the same trend across the group. In Uganda as well, there were some measures taken in those 2 years, and then they've stabilized now, and it's like that across the group. So we often read that people are saying that we retrenching, but we're not. As you can see, our work complement now is actually what is actually sustainable for us now. It supports our business. The financing cost one is a big one, as I mentioned. You can see with the drive that we had of reducing loans and financing costs in our basket, we've actually managed to bring down the level of financing costs, as I mentioned when we were talking about the P&L, from the 2.2 levels, which was really high in 2012 when our borrowings were extraordinarily high, and then dropped to 1.6 in 2013. Remember, in 2012, we incurred all those forex losses. We were borrowing huge amounts of money to actually just meet our obligations opposite those very expensive forward hedges that we had with various banks. And then in 2014, we dropped the financing costs further to 1.3. Of significance is this year-to-date March figure. We've incurred 221 million shillings. This figure will reduce going forward even furthermore. So it's not to be extrapolated and say we're going to close the year with like 800. We really are putting in full blast efforts to actually make this figure come much, much lower than what we spent in the first quarter. And it's actually a key thing for us to do, and it's actually driven, chaired by David, of course, and all the subsidiaries also very focused on this one to make sure that we achieve the objectives at the end of the day. So you can see with the reduced borrowings and also the reduced financing costs, we've improved our interest cover quite a lot, almost doubling it in the first quarter of March from what we achieved in 2014, and even from 2013, the 2014 figure improved. So you look at our financing cost trends. This is actually only Kenya because it's the biggest figure on the P&L where financing costs concerned. You can see the red line is the forex, which we've got no control over, but the one in blue is the one that we are really keeping tight focus on that, and you can see the trend is down so that we can bring this to levels of much less than the 100 that we've been seeing. In fact, we actually 53.
The red line says a lot. Huh?
Yeah.
It's not that the shilling is not bumpy, super bumpy now. And in the past, when it was bumpy, when you check the highs and the lows of the red line, it's usually when the shilling was either gaining a lot, like it happened in the past, or losing a lot, like it's happening today. But the way we structure the basket of dollar versus inflows of dollars versus liabilities, you see we are less vulnerable. If you check last month, I think Peter, we lost 2 shillings. And in Kenya, we gained 2 million shilling exchange forex. So it was a gain when shilling lost heavily. In the past, you could book 300, 400 million in 1 month when we had all the dollars liabilities, mainly because of the trading. So when you go and see the column of 2012, most of was the exchange loss, but it was not only the exchange loss because of the hedge, it was a lot to do with our position, because you create a liability. The moment you win at cargo, you load a ship, you create a liability in that day. You book it in your stocks, then you'll be paid 3, 4, 5 weeks after. These 5 weeks, when the shillings keep losing, that's what was hitting us badly. So the shilling is super bumpy now. We are today at 96.75 this morning. And you can see the trend of the red line, which we are very happy. It's something that in 2014 reports is not good. 360 was not good for us. What you need to understand that at 360, half of it came from subsidiaries, which is it was new to us. Half of it was Kenya, so Kenya for sure going to be lower this year, but also subsidiaries, we are taking some measures. And you see the number, I think you are presenting it, yeah?
So this is the forex losses that you saw in the P&L, the 105 million in 2013 and the 367 in 2014, which we're not happy about, of course. And year-to-date to March, we incurred 50 million. But as David explained, the basket of our dollar-denominated assets actually exceed our liabilities, and that's why with the weakening we're actually making some gains.
See, this 50 you see, it's actually less in 4 months because we are keep gaining now. So when the shilling is, what was hitting us badly in the past, when the shilling is losing, and he lost in April, is losing heavily in May, we are gaining as a group. So this number as we go forward is been reduced. So we put as a target as management, we put it to the board, that we are targeting to have 100 million this year max of exchange loss, but there is high potential with the way the shilling is behaving that it will be even below 50.
On the EBITDA, we spoke a little bit about it, where I showed on the table of the P&L the 3 billion that we achieved in 2013 and improved to 3.8 billion. This March, 1 billion is very good, and if you extrapolate, we'll actually, we hope to exceed just an extrapolation by 4 of this figure, but...
Yeah, we are targeting 4.2, 4.3 billion, and we think it's achievable. And even you go back, I don't think we were at that EBITDA previously.
You can see,
you know, the
actually,
2011, 2012, just
yeah,
letting
this
off
one you
each other.
just,
So
yeah.
I'm jumping this high and low. But when you go history, the company I don't think achieved 4 billion. I know,
No, you
we
can
never
see
achieved
even 2009, which was the strong years, we never got there. Okay, and this is just the net profit after tax. I won't dwell on this. You saw the figures before. Again, a good trend. The earnings per share, just a factor of the earnings. This one is an interesting one for us because we measure our sales by business segments. So you can see the blue is the retail, the inland is our network and the commercial business, and the orange or the yellow is our exports, aviation and the trading business, and the purple is our niche markets. This is the specialty products, the lubricants, LPG, non-fuel. You can see sales-wise they contribute very little, but you'll see on the profit margin, profitability, they actually contribute a lot. So the shape last year was a bit different. The retail contributed to sales 60%. We had a big contribution in 2013 of 37%. I think we had an OTS cargo there that actually had big sales, of course, but profitability not there. And then the contribution of the niche markets are similar to what we got in 2014. So if you look here, the shape changes when you look at gross profit. So you can see in 2013, the gross profit that Inland achieved was 71% of the total gross margin of the group. And in 2014, they achieved close again, about 69%. In 2013, the exports, trading and aviation contributed 15% on gross margin level. And in 2014, because we got out of some non-profit segments like we changed aviation customers to have better contracts, giving better margins. Our commercial business, we also changed the basket there. We had some loss-making customers. We gave those, we didn't re-tender for the, or we tendered that we didn't win those. And of course we were out of trading. So you can see it actually makes a big difference where they then contributed bigger share to the gross margin, and then the niche markets again contributed 14%. This is the net profit after tax. So you can see Inland contributed in 2013 they contributed 140 million. In 2014 they did much better, very much better, 436 million shillings. Our exports and trading aviation, they made a loss in 2013. They were profitable in 2014. And the niche businesses were they made 453 in 2014.